Afternoon everyone, welcome to today's FOMC prep. Today will be the fundamental preparation. Tomorrow we'll do more trade plans and trade ideas. As to replicate the Fed, they have two-day meetings, so we do the same. So our objectives today, firstly we'll go through the Fed mandate, the meeting format, and their previous meeting, what actually happened. Brannigan will go through that with the statements, the minutes, the market reaction, price ladder video. He will then go through the data since the previous meeting. Obviously that meeting was 6 weeks ago. I will then go through market pricing and expectations, and then we'll touch upon the key focus points as well. Okay, so the Fed mandate, you should all know this, and it doesn't change. So it's to support continued progress towards maximum employment and price stability. So essentially inflation, employment, unemployment, or the various measures surrounding employment. The format, so as most of you know by now, or should know by now, we have two differing formats for FOMC meetings. This time round we're scheduled, first of all it's 6 o'clock because of the clock change, 6 o'clock our time, 2 p.m. Eastern time. So at 6 o'clock we're due to get any announcement of a change in interest rates, the Fed funds rate, announcement of any QE or tapering, highly unexpected, and then a statement release. Now we normally get as well, or sorry, we're not scheduled to get rather a Yellen press conference or a Q&A, because generally we get press conferences and Q&As at every other meeting. But she has said in the past, if we're going to move rates, if there's a policy decision going to be made, we may do something else. So that's why we put it in question marks. It's not scheduled, but it could happen. And if something is announced that there might be a press conference or will be a press conference or Q&A, in all likelihood we'll get this information in advance, and it probably means something big has happened. So it's very important. This is not normal. Generally every 3 months we have a press conference and a Q&As. We're not scheduled to have one this time around.
Just guys, what that means in essence is from 12 o'clock tomorrow you don't move from your desk. It is as simple as that. You just don't move. There's no need to move. Yeah, I know we'll have obviously part 2 in here, but there's no need to move tomorrow. Yeah.
Because we don't know when they will announce anything, if that's indeed the case. Okay, I'll pass over to Brannigan for now, and you'll hear a lot more from me later on.
Okay, guys, I'm not going to go through that statement. Later on, if you want the statement, to go read through it, to look what it looks like, that's effectively what it's going to look like. That's how it's going to come down the Reuters. Okay, we will highlight certain things again tomorrow. The tricky thing with the Fed statement is obviously they keep changing their statement, they keep adding things, so they're not very consistent. There's no real key words you can focus on. But in essence, you're going to have 30 seconds to a minute to interpret that statement and respond accordingly. Right, the important thing is what effectively changed. So where have we gone? So if we go to the next slide, we're going to have a look at the changes. Now the first thing I want to discuss effectively is the change in the Fed stance from April to date. Okay, so initially back in the April meeting, the Fed were very much data dependent. They were very focused on the unemployment rate and on inflation. We then went to the June meeting and we suddenly became data dependent with focus on inflation. Okay, so the Fed had said, we're nearing full employment. The unemployment rate continues to tick down, and as a result, we're probably going to see wage pressures start to pick up back in June. Then all of a sudden, we got to September meeting, and the Fed were no longer so much hammering on about data dependency. Okay, it's still a part of their what they're looking at, but they became a little bit more China, emerging market, and dollar dependent. Right. So that's where we are today. That's what the Fed's thinking is. They're thinking what is happening in China, emerging markets, and dollar dependency. Okay, this is going to be the 3 hot topics of the meeting over the course of today and the course of tomorrow. Right, if you can answer the question of what's happening there, effectively you'll understand what's going to come out of the statement tomorrow. All right, let's summarize that statement from September. So very briefly, in essence, the Fed said they will hike with some further improvement in the labor market. Okay, so they still want to continue to see the labor market improve, and when reasonably confident inflation will turn back to 2%. So okay, that's pretty much standard over the last couple of meetings. It was a unanimous vote in September, and they repeated, sorry, that's not September. That is June. Sorry about that, that's September. Okay, and they repeat that inflation continues to run below objective, partly reflecting the early declines in energy, so transitory. Then, from there to September, effectively now they've gone to monitoring developments abroad closely, so China, emerging markets, and the dollar. They downgraded their dots. Okay, we know about that. They upgraded effectively their near-term growth, but downgraded longer-term growth, and they downgraded their unemployment forecasts. Then, something to pay attention to. 13 of 17 members wanted a rate hike in 2015. It's important to understand that because in essence, we should get some sort of an idea if there are still that many or that much of a consensus that want to hike this year. Why is that important? Well, because we've only got one more meeting after tomorrow, which is December. So if they still have that stance as of the close of business tomorrow, it means the Fed think we're going to hike in the next 4 weeks. Okay, bearing in mind, obviously, as Imran will talk about, the market is only pricing in roughly, I think, 33%, yeah?
Yeah.
Somewhere around 33% chance of a hike in December. Okay, then obviously they went on, global economic and financial developments may restrain economic activity somewhat, likely to put further downward pressure on inflation near term. In other words, the slowdown in emerging markets as a result of the slowdown in China, as a result of continued dollar strength, could effectively impact near-term inflation. That was the Fed's concern at the previous meeting. The question is that their concern as of today and tomorrow? Okay, again, it all comes back to, if you can answer the question as to the Fed's thinking around China, emerging markets and the dollar, you will get a very good idea of the outcome of tomorrow's meeting. Alright, that's effectively a summary. Now, just very briefly, we're not going to do the video today, we're going to talk about the video tomorrow in the opportunities, but in terms of market reaction, it's important to understand what the market's expectations were or pricing was going into the meeting. So, the market expected, note, the expectations was for either a hawkish signal, in other words, some sort of intent from the Fed, or a dovish hike. That was the two base case scenarios. Right? We went in with roughly, what was 30%, 40% chance?
30%, yeah.
No, in the previous meeting.
Yeah, 30% of that meeting. Yeah.
So it was a 30% chance was priced in. So there was some consensus for a potential, if not hawkish, a potential hike. Right. So initially we didn't get that. We got an outright dovish. So an outlier on the expectations. Right. We got very much a reversal of the positioning, and I will show that to you in the charts in a minute. And then obviously we remained dovish throughout. Why? Because the market said if they're concerned about China and the emerging markets, this is not a short-term thing. Right? China won't turn around overnight, neither will the emerging markets. As a result, the market said we're not going to hike at all this year, and they've priced out any further rate hikes for this year out into next year. Okay, that was a summary in terms of the market reaction. We will do that video tomorrow. And let's just quickly have a look at those charts. Now, it's important to understand this because when you prep tonight, you need to make sure what the positioning in your market is. So the first thing is, let's just look at the dollar index quickly. And if you can shut that light off, please, Ross. Right. What I want to point your attention to effectively are these little blue lines here. Now, the reason they're very important is because, in essence, what we saw 2 days before the meeting was a very, very aggressive move. I think it was almost a 3-4% move in the dollar 2 days before the Fed meeting. Okay. At the same time, if you open up the 2-year, right, note the 2-year is particularly rate sensitive, but you can see in the exact same 2-day period, we saw the 2-year rallying 10 basis points. Okay, so very, very aggressive pre-positioning move going into the meeting. Right. Keep that in the back of your mind. Whilst there isn't really a probability of a hike tomorrow, remember the outlier. In other words, the good risk-reward gamble is that they signal tomorrow. Right? So you will most likely see some of this pre-positioning over the course of tomorrow. Keep that in the back of your mind. All right? Participants tend to behave the same way if the risk-reward is still in their favour. Okay, that's effectively the two positioning charts. Now, let's move on and just talk a little bit about the data over the course, or actually we can quickly look at the dot plot, just so you guys get an idea of the consensus. Okay, so as you can see, obviously this is the June dot plot and the September dot plot. Note, we had quite a good consensus view back in June. We still have that same consensus view. Okay, so the Fed are, whilst they have got some people that don't agree and that sort of say we're never going to hike. In general, on average, everyone is in agreement that we're going to hike this year. So is that still the case, guys? That's the question. Is it the case that the majority still think we have a hike? If they do, tomorrow's meeting is going to be fantastic. All right, other than that, obviously, this is anyone's guess. That'll change over the course of the next couple of months. But the important thing is focusing on this meeting and obviously the December meeting. All right. Now, let's look at the data and get a feel for what's happened. We all know we had the stinker NFP number. All right, we were expected to see an upgrade in the August number due to seasonality. Note September's meeting September's NFP was particularly weak. Right. However, unemployment stayed steady, and the other sort of outlier from the meeting was the earnings growth. Right. If we take a quick look at the chart of the NFP, you'll see the important thing to understand is the Fed's not necessarily focused on individual meetings. All right, they're focused on the average and the trend. Now, that's why we have this purple line here. In essence, on average over the last 12 months, we're creating 230,000 jobs a month. That's still very positive for the Fed. Yes, of course, they don't want to see that. They don't want to see sort of, very weak numbers. But equally, so long as the trend is maintained, that's all that matters. All right. Then if we look at the wage, with the wage growth, in fact, we'll get to the wage growth in a minute. So PMI manufacturing, okay, remember the US is not as manufacturing driven. It is important to them, but they're more a domestically driven economy. But the important thing, sorry. Okay, I'll just keep going, you play. Alright, so the manufacturing obviously ticked down to just above expansion. Again, the Fed doesn't particularly want to see that, but again, you have to ask yourself, because it's not as important to the economy, are they really going to focus on that? Then one of the key inflation gauges, the core CPI, very important, it ticked up. Now I'm going to show you what the chart looks like in terms of the CPI, because this is something the Fed does focus on. For a long time they've moved away from looking at headline inflation because of the transitory factors. Now, as you'll see, effectively, I'll point your attention particularly to this section here. This is the last 2 years of inflationary data now. Over the course of the last year and a half, we've been stuck on 1.8%, and suddenly this month we actually ticked up to 1.9%. Okay, it's the highest read in core inflation in 2 years. All right, now that's important to know, because if you go back through the previous statement, and particularly last month, you'll see the Fed made specific mention about the concern. In other words, they were saying emerging markets in China are concerned because it is likely to put further downward pressure on near-term inflation. Okay, yet we had a positive inflation number. Inflation was higher than expected. And that's something the Fed's going to have to think about, because it is obviously, they are most important to them is to keep inflation under control. Right. Also note, I've just included this purple line here because that is effectively the interest rate cycle. As you can see, the Fed moved, in other words, they started hiking rates well before the trend in inflation started to pick up. Okay, so equally, if this is the start of the trend now, the very aggressive trend back towards their target 2%, right, do they respond now and actually hike or signal a hike? Okay. That's the core CPI. Then core PCE, okay, also this is their preferred measure. Why? Because it shows consumption expenditure, so it shows physical inflation coming from the consumer. Very important, it has stayed steady at 1.3%. We have got the chart of that. Very important to see, okay, again, that number was particularly low, one of the lowest numbers we've had in sort of the last 4 years. That's hence why the Fed were a little bit sort of hesitant to move. But the question is now, is that a bottom? And then at the bottom here, we've obviously got the earnings data. As you can see, earnings data has been very, very flat for a very, very long time. But the Fed's thinking is that as jobs start to pick up and more people get paid, and there's more demand for jobs and less supply, the wage growth should pick up, and ultimately core PCE should turn and go higher. Right. And let's just look at some of the other important pieces of data. Retail sales, again, as we know, particularly weak. Unfortunately, there's no seasonality behind that, but you can see minus 0.3 versus minus 0.1, not a good number for this month. Then let's get on to the more important charts, the inflation expectations. Now, as we can see, it plunged. We saw a very aggressive down move inflation expectations. Why? Well, it's simple. If the Fed tells us they're concerned about emerging markets and they're concerned about China, it means that the market should be concerned. Okay, if the whole world is slowing down as a result of emerging markets in China, it means that inflation expectations should drop off. Now, if you just scroll down to the next page, please. If you look down, if you effectively look what's happened over the course of the month, we sort of made a bottom in inflation expectations somewhere around the back end of September. Okay, and since then, inflation expectations have propped up. Now, it's important to understand that, because if you look at the same time where the US yield was trading, all right, the US yield is effectively not really bounced as aggressively as the inflation expectations has. Okay, now that could mean one of two things. It could mean maybe that the market has become again too dovish on inflation expectations, and effectively they're repricing that into the US 10-year. and in which case, if the Fed comes out and says, well, no, hang on a sec, things are better, we should get a rebound. All right, if you want to have a look at that idea and that trade idea, just go look at the German bonds. All right, you'll see back in April, inflation expectations had sort of fallen completely down, and the whole market was in disbelief that there ever was inflation, and the next thing, German bonds collapsed very spectacularly back in April. Okay, so those divergences do occur, but obviously they do correct over time. All right, then let's look at the last two charts. First one is the oil market. Very important. We look at oil simply because the Fed looks at oil. The Fed keep mentioning it. They keep telling us that the impact on inflation is transitory. Now, the first thing to understand before we talk about oil is that we've had two central banks come out now and tell us that the base effects of oil are going to start falling out now at the back end of this year. So what does that mean, guys? In essence, if you look at your year-on-year inflation numbers and you take this year, so you take maybe October's reading from 15 to October 14, okay? Because oil was particularly low in October, December, January, February, over the back earlier this year, those impact on the headline inflation year on year are going to start falling out now, right? So what Yellen's telling us is that as a result, because of these base effects falling out, we should start to see inflation rise. So if she is correct, you should start to expect higher inflation reads. Right? If she's incorrect, you should see inflation remain lower, and if not, go even lower over the next couple of months. In which case, we do go into global deflation, and it's the end of the world. All right. The important thing to understand: what has oil done? Well, in essence, that's where oil was in the previous meeting, somewhere around $44 a barrel. We're now trading $43 a barrel. So oil hasn't really moved since the previous meeting. Still very dampened expectations, and a lot of people still talking about much lower prices in the oil market. Okay, and then the last one is obviously the dollar index. If we can just briefly look at that again. As you can see, all right, dollar effectively at the last meeting was trading somewhere around the index 95. It's trading as of today 96. So very little movement in the dollar, nothing major going on. What I do want you guys to understand with regards to the dollar is, how has the dollar performed relative to the emerging markets? And then obviously relative to some of the other major currency pairs. So the first thing we can look at is obviously the emerging markets. Now, what I want to point out to you guys, and this is particularly important for the Fed, right? If we look at these bottom charts, and you'll note I do show you these quite often, but in essence, over the last couple of weeks, we've actually seen a nice recovery move in the emerging markets against the dollar. Okay, and this is important to the Fed. Why? Because the Fed not moving is not because of their own economy. Okay, the Fed is concerned that if they were to hike, all right, it will effectively have a spillover effect to the emerging markets. The emerging markets will struggle to pay off their debts in dollar denominations, and as a result, they'll demand less, and that'll have a second round effect for the US recovery. Okay, so that's where the concern comes with the Fed, right? So important to understand that the emerging markets have performed particularly well since the previous meeting. They're actually doing quite nicely. The second thing to pay attention to, if you get the rebasing chart up, is what has the dollar performed well against and what has it weakened against. And if you look at this chart, effectively what I've got here is the rebasing index. And as you can see, the top one is the ZAR, so the US dollar ZAR. You can see that the Rand has performed particularly well. You've then got the commodity currencies. They've done particularly well. The Aussie and New Zealand dollar have done particularly well against the dollar. And the weakest performer has effectively, the black one, has been the euro-dollar currency. So if net to net you go and look at this since this blue line, you'll see that nothing really has moved since the previous meeting except for the euro-dollar. Right, so important to understand that. Everyone's going on about, if they hike, then the dollar will become too strong and it will be the end of the world. Right, so it's important to gauge where will that strength come from in the dollar. If there's strength in the euro against the dollar, there's absolutely nothing the Fed can do about that. Why? Because Europe is going more QE. Alright, so important to understand that. Okay. Alright, other than that, that's pretty much all the charts that we're going to look at today. And I think that's pretty much me. Your turn.
Thank you. Okay, so market pricing, whether you trade the stairs or not, whether you trade interest rate products or not, you need to know what the market is pricing. So, and we also need to know what the current rates are. So the current Fed funds target rate is 0 to 25 basis points. We are actually slap bang in the middle of that at the moment, 12 basis points. It was 14 basis points at the last meeting, it's 12 basis points now. The market pricing, as per the Fed funds futures, is pricing only a 7% chance of a rate hike tomorrow. Now, that's pretty much nothing. We mentioned at the last meeting they were pricing a 30% chance. This meeting, only a 7% chance is priced for tomorrow. And actually, the market is pricing the first full rate hike, the first full 25 basis points, for May 2016. That's not to say they're not pricing in a little bit for months earlier, but it's fully priced by May 2016. Now, if we look at it from earlier this year, generally the first full rate hike was priced somewhere around September, October, December, whatever it may be. Now, obviously, we haven't had that hike. The market has just kept pushing that hike back and back and back. So, if we look at the current dots, obviously we have no new dots released this time around because they only update those every 3 months. The dot for 2015 is 0.375, the median dot. So essentially, the market pricing for the end of 2015 is a Fed funds rate of 0.2%. So still, the market is not pricing a rate hike for this year. The Fed, Brannigan mentioned 13 out of 17 members last time around said they expect a rate hike this year. The market is not believing that. They're only placing maybe a 30 to 35% chance of that rate hike coming by the end of the year. Then we also have the market pricing for later, for next year and the year after. But to be honest, we're not that concerned about that at the moment. This is very important information. Yeah, the pen's not working. This is very important information, but the focus this time around shouldn't really be for what's happening next year or the year after. It will be this meeting and the next meeting. Everyone, all market participants, investors, speculators, news reporters, what they're concerned about is the first rate hike. When will we get that? Will it be this meeting? Probably not, according to market pricing. But will any of you be shocked if it happens? Well, the Fed have been saying we expect a rate hike this year, so if it happens, you shouldn't be shocked, although it might be considered an outlier trade, but we'll go into that later. So the Fed does meet 8 times a year. The market pricing is the dots imply 1 hike this year. The market's not really pricing it. And as we go further out, essentially the market expects a later lift-off from the Fed and a slower path of rate hikes, as represented by the dots versus the market pricing. Okay, so I've outlined the market pricing, but there are, we have the release of the Fed funds rate tomorrow, if any change or not, but the key thing will be what's in the statement, in my opinion, provided we don't get that outlier rate hike. And the key things to watch for, as I mentioned, the Fed funds rate announcement, 2, the economic outlook, 3, language and forward guidance, and that probably becomes even more important if indeed, as expected, they don't hike rates, and 4, the global outlook, which Brannigan touched upon. So, the Fed funds rate, what will cause them? What are they looking at with respect to moving the Fed funds rate? And bits in red here are where to actually look in the statement for them. This is what they've been saying. So they will take into account a wide range of information, including measures of labour market conditions, indicators of inflation pressures and inflation expectations, and readings on financial and international developments. They've always said this pretty much, but this international developments part has taken more focus because essentially last time round, that's why they didn't hike rates. And the next bit here, they've said this for as long as I can remember, the last 6 to 9 months. Appropriate to raise the target range for the Fed funds rate when it has seen some further improvement in the labour market and is reasonably confident that inflation will move back to its 2% objective over the medium term. So essentially, now they've always had the dual mandate of employment and inflation being back within kind of where they want it to, but last time some people referred to it as a third indicator now, the international developments. So now they're looking at, as opposed to 2 things, more 3 things. So what are the scenarios for tomorrow? A 25-point rate hike, yes. Fed will hike if they believe the above conditions have been met. Analysts and the market see minimal chance of that. Unchanged rates, well, it will occur if the Fed believe the domestic economic outlook or the international developments are more uncertain or are still uncertain, and this is the consensus view that there wouldn't be enough change in the data or the international developments to follow through with a rate hike. But we will see.
Just to add to that, sorry Imran, as I think Horhan mentioned last month, I think Charles Plosser came out. He said that in history the Fed's never hiked when there hasn't been at least a 70% chance priced in. Right, so I know that's not necessarily has to be the case. History is there for the changing, but do keep that in the back of your mind. That the Fed doesn't really want to surprise the market. If they had their way, they'd prefer the market to be fully priced. Okay, so do just keep that.
Absolutely, they would prefer that. But as I said before, they've been trying to kind of guide the market all year, and the market's never really believed it. They have 13 out of 17 participants 6 weeks ago still believe the first rate hike would come this year. Now the market doesn't seem to believe that. So that 70% stat is a very good stat, but the Fed could quite easily argue, well, we've been telling you all year we expect it. Don't be shocked. And invariably, if they do hike rates, the market will be shocked because it's not pricing it.
And don't forget, guys, that 13 out of 17 members was at the time of the slowdown in emerging markets and China, yeah? So in other words, they had taken that into account. So don't forget that. Okay, because effectively they still believe that with the slowdown in China and emerging markets, now that we've seen China rally, another rate cut now, we've seen emerging markets bounce, you know, what is their thinking now?
Okay. So that's the Fed funds rate. Now, economic outlook, and when I say economic outlook, I'm referring to the domestic economic outlook. They're looking at inflation, they're looking at employment, they're looking at growth. In the statement, this is what they said last time around. These two things are the things to take away. Recent global economic and financial developments may restrain economic activity somewhat and are likely to put further downward pressure on inflation in the near term. So, what are we going to look out for? You know, near term. Will that maybe spread to the medium term? Fed are concerned with medium term outlook. In the near term, they're not really too fussed. So if this changes and it has downward pressure on inflation in the medium term, that is dovish. Additionally, they could say something, you know, along the lines that it's unlikely to provide further downward pressure in the near term. So that could be deemed as hawkish. So these subtle changes are things you need to be looking out for. And in your trade plans, you have to do your scenario analysis. What if they do this? What if they do this? It will only be a subtle change, but that subtle change can make you money. And the other thing is, again, they've said this for a long time, inflation is anticipated to remain near its low level in the near term, but the committee expects inflation to rise gradually towards 2% in the medium term. And the thing to take away from these two statements is, one is reflecting near term, one is reflecting medium term. Fed have said many times it's all about the medium term, and inflation in the near term being low is transitory. If that changes and shifts around somewhat, there will be an opportunity. Now you have to do your scenario analysis, what's hawkish, what's dovish, how could they change it? Those are things you need to think about before we come in tomorrow and talk about our trade plans.
So can I just, with regards to the inflation, guys, so important. Okay, Fed's Yellen has told us a number of times that we don't have to be at 2% inflation. Okay, she just has to be reasonably confident that inflation is heading higher. So if they're going to signal, remember tomorrow's not going to be straightforward like, oh, by the way, we're still going to hike December. They're going to change something with regards to their inflation expectations that will signal to the market. So most likely, if there's going to be a signal, it's going to come in that exact paragraph, that wording about near-term inflation. Okay, so important, guys. Read over that statement, pay close attention to it.
And also, up until the last meeting, it was inflation that was preventing them from hiking rates. Employment, which we look at, in the statement it says labour market continued to improve with solid job claims and declining unemployment. That's been said for a long time. It has not been their concern. It has always been inflation. Now, Brannigan showed that the last non-farm payrolls numbers was weaker than expected. Wage growth wasn't what the Fed would like it to be. So maybe will a much weaker than expected NFP derail the employment outlook for the Fed? We don't know, but this is what they've been saying. The labour markets continue to improve with solid job gains. Could they change that? This might prevent them from hiking rates. That actually, it didn't continue to improve last month. Okay, it wasn't negative, but it's very slow improvement relative to what was expected. And growth, to be honest, growth is up. Growth has just not really been too much of a concern. You know, obviously, they say economic activity is expanding at a moderate pace. To be honest, I don't think that matters too much, but I put it there nevertheless. Okay, then language and forward guidance becomes very important as well. So we touched upon the main parts of what to look for in the statement: inflation, employment, growth, but the language and forward guidance, and I reiterate this again, appropriate to raise the target range for the federal funds rate when it has seen some further improvement in the labour market and is reasonably confident that inflation will move back to its 2% objective over the medium term. This is the key part of the statement. This is what you need to focus on. This is essentially, in addition to the economic developments, what the Fed will base their decisions around. So Now, the Fed liftoff, people, speculators, analysts, whoever it is, want to know when this first rate hike is coming. So if they don't hike rates, what guidance will they give? When will that first liftoff be? And that sort of links into something I've put on here, hints of a 2016 liftoff, because if they don't hike rates tomorrow, the only opportunity they have to do it this year is in the December meeting. And all year they've been talking about rate hikes this year. So if it doesn't happen tomorrow, this is things we need to pay attention to. When will that first liftoff be? Will it be 2016? You know, like Brannigan said, they're not going to say slam dunk, we're going to hike in 2015. They will subtly change their wording to guide the market. The pace of any movement might be important. Is it going to be measured? Is it going to be gradual normalization? Very gradual. FOMC members in the past for the whole year have emphasized that it will be slow and gradual, but how slow and gradual, we don't know at this stage. Obviously, we haven't even started yet, so I think the pace probably is more important if they do hike rates. Then the market will be looking for what pace. If they don't hike rates, the market will really just be concerned about the first rate hike. Continued emphasis on data dependency, irrespective of the rate decision, as opposed to calendar dependency. They've often said they're data dependent. The market has generally wanted to know when the first rate hike will be, how quickly it will come. The Fed have constantly reiterated it's when the data suggests it should come. Time is not important, the data is important. This, to be honest, they will continue saying that because nothing has changed for them in that respect. And we mentioned it earlier, changes to press conferences. If they announce a press conference for tomorrow at some point, could be a signal, actually, probably is a signal that they're hiking rates. Now, I don't know how that might come about. Will they announce that at 6 o'clock on the rate decision? Will they announce that a little bit before? We don't know. This will be very unexpected, but we can make money out of these outliers, these unexpected outcomes, because the rate hike is the outlier. So essentially, why Brannigan said be at your desk from midday, probably not midday, probably after the US Open, I'd say, but 1 o'clock, whatever it is because we don't know. So if we don't know, they could announce something. There will be a press conference today at 1 o'clock. They could announce at 3 o'clock. They could announce it at 6 o'clock with the rate decision. We don't know. So that's why don't be away from your desks if you can avoid it. And finally, global outlook. Now, there's a lot more I'm going to go through on the global outlook because it was so important. It's what prevented them last time round from hiking rates, in my opinion.
Sorry, can I just add something to your language there? Very important, guys. In your statement, you wouldn't have seen it. Okay, but what you do is you get a lot of commentary on the statement. So you'll have the statement changes, but then you also get the many members thought this, many members thought that. Now, the one tagline that both Yellen and a lot of members have held is that they will deem it appropriate to hike rates if and when certain things happen. Okay, so if you get some sort of a line of many members thought it appropriate to still hike rates if further stability, that is the signal, guys. Okay, that many members, still think that it's appropriate to hike this year. Right, it's going to be a subtle line. If the Fed wants to hike this year, the market will almost be 100% priced come the December meeting. They will not surprise the market in December for many reasons. One is liquidity. Okay, so again, if the Fed wants to signal, and that's why I cannot reiterate this, tomorrow is either going to be extremely good to trade or it's going to be a damn squib. Right, there's not going to be an in-between tomorrow, so you need to come prepared. Right, as Imran always says, every meeting is live, and tomorrow is equally just as live.
Okay, so the global outlook. As I said, what I believe prevented them from hiking rates last time around because the data had been improving. Now, this wasn't actually mentioned in the statement, but I've taken this quote from the Q&A, from the press conference. Yellen said, the outlook abroad appears to have become more uncertain of late. Heightened concerns about growth in China and other emerging economies have led to volatility in financial markets. Developments since our early July meeting, including the drop in equity prices, the further appreciation of the dollar, and a widening in risk spreads have tightened overall financial conditions to some extent. Now, why I brought that statement up is she's telling us what she's looking at. Growth in China, emerging market economies, equity markets, appreciation of the dollar, and widening in risk spreads. So Brannigan's been through most of the charts, but she has told us what she is concerned about. So what she is concerned about ultimately needs to be what we're concerned about because we're trying to make money out of this. So, China, growth slowdown. Now, since the last meeting, last week actually, what happened? There was easing from China. There were rate cuts from China. Now, is this a good or bad thing? Well, maybe it's a good thing because it's a stimulative measure to try and re-stimulate the economy, but actually maybe China acknowledging our situation is worse than we first thought. So it's hard to interpret that, but all other things being equal, you could think a central bank is cutting rates, the Fed can't hike rates. Well, maybe it becomes easier for them to hike rates because China is trying to sort out some of their problems. So it can be viewed both ways. Emerging markets stronger. Brannigan showed it on the charts. The emerging markets are stronger across the board pretty much. Yellen, and that's in currency space, but currency space for the emerging markets is representative of their economies. So emerging markets, since the last meeting, have been doing pretty well. Dollar strength. Now, although the dollar is weaker against the emerging markets, which will be encouraging to the Fed, it's stronger against the G10. So, when the dollar index, it's the euro, the pound, the Aussie dollar, etc., that it's stronger against. Now, dollar strength has implications for growth and inflation. A strong dollar with weak global demand imports essentially inflation. So, as the dollar strengthens, inflation is likely to struggle to increase because you get imported disinflation rather. So that's something that we need to pay attention to. What are the Fed's thoughts on the strengthening dollar? Does it outweigh the benefits we've seen from the emerging markets? Who knows? But this is something that we need to think about. And also, actually, I'll touch upon that in a second, actually. US equities have surged in the last 4 weeks as well. We've had 4 consecutive weeks prior to this week, which we had 2 days, where the US equities have been up. In general, you look at the Dow, the S&P, the Nasdaq, they've generally been up somewhere between 2 and 4% last week, but that's been a constant theme for the last 4 weeks. So again, looking at this, drop in equity prices have concerned the Fed, but actually in the last month, we've actually seen significant improvements. So oil and commodity is another one, that the Fed have been not so concerned about, to be honest, because they've said we believe this to be transitory, and Brannigan touched on this as well. But the oil prices falling in the last year have been largely supply-led, shale oil production, we've talked about it before. But actually in the last 2-3 months, probably 2 months, it's been more demand-led, and that's more of a concern. Demand from China has been lower, demand from emerging markets has been lower, global demand for oil in general has been low, and that's probably what's pushed the oil prices lower, as opposed to the supply side shocks that have done it over the last year or so, year and a half or so. So if it is demand led, maybe that has wider implications. Are these low oil prices feeding into inflation actually transitory, or is it something more underlying beneath the surface that we need to worry about? And that's something that the Fed will consider. Up to now they've said transitory, so maybe in their statement somewhere we're looking out for, do they still believe it's transitory, or something along those lines. And then finally, the US economy is the exception to the norm. Everywhere else has been cutting rates, or easing policy, or QE, or what have you. It's only been the US and I guess the Bank of England that have been talking about rate hikes, because this year ECB QE, China rate cuts, Canada rate cuts, New Zealand rate cuts, Australia rate cuts. You go across the board in developed countries and you get easing of policy. Now, the Fed are the exception to this. If they hike rates, they're doing it against what everyone else is doing. Now, as we said with China, maybe the fact that everyone is easing is actually positive, because they're concerned about global growth. Countries are trying to stimulate the growth within their domestic economies, whether Europe, whether Japan, whoever it might be. So this is good for the Fed. So maybe they can hike rates because others are trying to sort out their problems. But conversely, easing elsewhere strengthens the dollar relative to those countries. So the dollar has strengthened partly because of monetary easing elsewhere. And if they hike rates, if they go and if the Fed hike rates, that's only going to lead to further dollar strength. So, they said it's a concern. The dollar is a concern. Yes, it is. If they hike rates, it's going to be more of a concern. But actually, maybe the other measures that other central banks have taken might outweigh that, because maybe they're happy for the dollar to strengthen so long as part of that strengthening is due to efforts elsewhere. Now, you can see there are arguments that you can say that the situation has improved in terms of China, emerging markets, equities, but then we talked about possibly the dollar strength is still more of a concern, or lower oil and commodity prices being more than just transitory being a concern, and also, as we mentioned with China, maybe there is a bigger problem than we first thought. So these are things just we need to consider, and why I've paid so much attention to this is because essentially the last meeting, this was what prevented them from hiking rates. Now, has enough changed to warrant a rate hike? Probably, if you take everything together, situation is probably better, but is it? There's probably still quite a bit of uncertainty there. Is there too much uncertainty for them to hike rates, not only tomorrow, but this year? That's what we'll be focusing on, the data as well as the global outlook. So that's it for today. We've gone through a lot of the fundamental preparation, the more, what I call, I'd say a bit more boring, but it's pretty interesting still. But tomorrow is when we're going to talk about our trade plans, trade ideas, how we can make money out of this. This is going to be interactive tomorrow. You need to come with your ideas, your trade ideas, your plans, your scenarios, because if you're not prepared, you're not going to make any money. That's guaranteed. That's a guarantee. In fact, you'll probably lose money if you're not prepared. And these outlier opportunities that we talk about, the rate hike will be a shock because the market is not pricing it. If that comes about, you can't say, I know Brannigan, I heard mention to someone, if they hike rates today and you don't have your best ever day of the year, you shouldn't be here. And I totally agree with him, because that is an outlier opportunity. That is something that the market will take as unexpected. But we should not be surprised, because we've been talking about this all year. We prepare for the outlier trades. We prepare for the consensus trades. And prepare to fail if you haven't prepared for this, basically. So we'll go through tomorrow something a bit on bonds, a bit on the dollar, a bit on commodities, a bit on equities. But I want you to come with your ideas and plans as well. We've talked to you pretty much today and fired, the stuff that anyone can really do. This is the easy part, just analysing what happened last time. Getting the economic side of it, getting the fundamental side, doing the statement sides, the analysis of the Fed. That's the easy part. Now, if you can't even do the easy part, you've got no chance doing the hard part, which is making money. So please come prepared. Obviously, tomorrow, same time, 4:45, Fed meeting is at 6, so there's less of a break. So, make sure you prepare in that sort of respect as well. Be nourished, have your energy, be ready. And obviously, as Brannigan said earlier, make sure you're at your desk most of the afternoon tomorrow, because just in case they do announce anything.
What we will probably do, I'm going to make an executive decision now. That's part 2 is going to be at midnight tomorrow. Yeah, there's no point in us not being at our desks from the US session open. So this will be around about 11. We'll confirm the time tomorrow. Yeah.
Okay.
Cool.
Enjoy, everyone. Hope that's helpful.